very brief introduction. I'm Dirk from FinPlanet. FinPlanet is a small boutique which is focused on DLT-based business cases for fintechs, exchanges, asset managers. So what is the motivation of the study? Already in 2018, we were discussing it with Stuttgart. Back then, I was CEO of Stuttgart Digital Exchange. We were discussing. We were discussing with Axel Springer and with SBI, Japan-based bank. We were discussing that they wanted to invest in like the digital endeavors of Stuttgart, and they asked a simple question because our narrative back then already was blockchain technology will disrupt the financial industry because it's cheaper, it's more efficient. And the simple question they asked back then was, okay, if you say it's cheaper, how much will it be? So what is like, can you quantify it in base points? And back then it simply wasn't possible. So even we, with the expertise as Stuttgart Stock Exchange, we did a number crunching, but we simply failed. And after that, we did a lot of projects with other incumbents, and every single time the question came up, so how much can we save? And none of the incumbents was able to quantify it. But what we found out discussing this topic with different incumbents is that everybody was able to add like a certain piece to the puzzle. So then we discussed together with Cashlink and with Porsche Consulting, because they're bringing in great expertise for the study too. We wouldn't have been able to do it on our own. We discussed it together with them that we want to give it a try. At the end of the day, it took us maybe 18 months, some like 12 months to run the study. So it was really, really painful. We did a number crunching. We did a lot of expert interviews. And this is where we are right now. You can find the study, you can download it on tokenization-study.com. And what you also implemented is a GPT. You need to have a ChatGPT Plus account, but then you can talk with ChatGPT about our study, and the results are really great. So if you don't want to, read the whole thing, read the thing, that you can.
Or listen to us today.
Simply ask ChatGPT or us. Yeah. So this is the motivation for the study. Can I skip here somewhere to the next slide?
Sure.
There's a clicker, and you can sit down if you want.
Let's do that. So what are the key results? First of all, it's getting cheaper. I think Marius, you will later elaborate about assumptions of this specific stock, because this is very crucial to quantify the specific cost-saving potential. But we ended up with the cost-saving potential of 7 to 15 base points per annum, which is a lot in the financial industry in this specific use case. The second finding, which is very interesting, is that the cost-saving potential is especially in the middle and back office. And this is interesting because when we think about how we discussed digital assets maybe 1 year ago or 2 years ago, also here on the CryptDesk conference, then most people were saying, look, this is more like a sales-driven topic, that we can disrupt distribution partners. Siemens can now directly place their bonds at the investors without having a bank in between. And this is not a discussion anymore. So actually all the banks that we're talking to, all the experts that we interviewed in the study, they're completely focused on middle and back office processes. So this is a quite interesting study. And the third part of the study is, we will see it on a later slide. We are not there yet to really raise the efficiency potential. So currently, DLT-based capital market infrastructure is even more expensive than the current infrastructure that we're having. The main reasons are simply because tokenized securities don't scale yet. The volume is simply too small. And the second reason is that the Cashlink is missing. So these are like the two main drivers, so which both need to be fixed.
All right. So what are the major assumptions and methodology of the study? I think, first of all, we measured the maturity of the DLT infrastructure by looking at 3 different points in time. So we were looking at today's on and off-chain world. Then we created a 2026 scenario where on-chain, which is different from the on-chain world today by incorporating a functioning cash leg. We then developed a 2028 scenario which is in a technical sense similar to the 2026 scenario, but with added scale, with added volume. So those are the three different points in time. Also, we distinguish between domestic and foreign investors, and not so much because it would make a lot of difference on-chain, but it does make a lot of difference in the off-chain cost basis. Because if you look at the cost basis today off-chain, there's quite a significant difference whether or not you incorporate a foreign or a domestic investor view. As Dirk already mentioned, we were looking at a corporate bond, 50 million notional, 8-year maturity. I think one of the greatest assets of the study was our access to high quality data. So, for example, we incorporated real crypto registrar data, also from other market participants, public pricing schedules. We did lots of expert interviews, as you mentioned before, Dirk, and of course also did our own research. And it's also important to mention that we had a pure bottom-up approach. So we're basically moving through the ETV value chain, looking at every single process step and identifying potential DLT efficiency gains. All right. Yeah. So starting with the cost basis, and also with the types of costs that we're actually looking at. We're looking at 177 basis points, and this is for the entire life cycle of the bond. It's not just for the yearly basis points; it's for the entire life cycle. 60% of those are in the front office, and as you also already mentioned, Dirk, the study does not indicate that there are any major efficiency gains in the front office, at least none that were directly related to the technology, to DLT. It looks different in the middle office, for example, at trade flow monitoring. That was one of the first process steps where we actually found significant DLT efficiency potential simply because of the various multilateral reconciliation efforts that are taking place there. Looking at the back office, for example, depository business is a very important cost type, and it's also one where you can see what happens if you're looking at different maturity levels of the DLT infrastructure. If you look at the depository fees on chain today and compare that to the off-chain depository, because you will find that nothing will become cheaper. It's the contrary. It's the on-chain world, especially if you look at depository business, is more expensive. And Simon, you will elaborate a little more on that later. But if you, with added maturity of the infrastructure, with added volume and scale, you see those fees dramatically decline. I think clearing settlement, that's also noteworthy, obviously, and we've talked about this through other panel discussions today a lot. Obviously, there are lots of efficiency potential there, but at least for the domestic case, the absolute numbers are quite small. So yes, you get a percentage-wise, you get a lots of efficiency potential there, but the numbers, at least in the domestic case, are quite small. So that's not really where in absolute terms the most efficiency potential is coming from. It's different when you look at corporate actions and asset servicing. It's simply a much larger pool of BPS to draw efficiency potential from, and that's also why there's a lot more efficiency potential there. Obviously, global certificate and security issuance costs are important to mention. Also, reporting costs that kind of completes like the cost-based view and the types of costs that we were looking at in our study. Nice.
Yeah, so let's actually look at the impact on the value chain. We're now looking at the domestic investor case, meaning the investors that invest into the bond are domestic and not cross-border. So the impact on the value chain that we have identified here is overall 71% cost savings over the entire life cycle of the bond, which is pretty pretty good. We will jump into like how like the implementation of these cost savings could look like on a timeline level. But overall, through DLT tokenization and also the Cashlink on chain, we can realize these cost savings with volume and the Cashlink on chain.
This is like the comparison today's world versus the 2028.
Correct. We will have a look at this in a bit as well. The main cost saving or the cost efficiency sources here are obviously corporate action and asset servicing, all the dividends calculation, ownership, identification and so on. But of course also trade flow monitoring and depository business are like the medium and high impact parts of efficiency sources that we've identified. In the cross-border case with foreign investors, it's even more efficiency gains potential because we can realize up to 85.1% cost savings over the life cycle of a bond. Here, of course, we have high cost savings in the clearing and settlement part because clearing cross-border today is very expensive, and you only have to look up the Clearstream public pricing schedule, and you will find a lot of detailed information regarding that for all the different countries that you do cross-border business with. Of course, there's also the securities account additionally to the other corporate actions and trade flow monitoring parts as well. But are we there yet? No, we are not there yet. So let's look how we expect the timeline to be for the cost saving realization. And on the left side of the slide, you have the costs for the domestic investor bond as of today. So if we look at the same bond and issue today on blockchain, and also like consider all the costs for custody on-chain, tokenization, crypto securities registrar, of course, also corporate action and so on, we would actually have increased costs as of today. Why is that? Because the running costs are quite high, but we only have very little volume on the infrastructure with the same running costs, right? So this is very similar to also the traditional world. If you would only have one product on the traditional infrastructure, the underlying costs would be gigantic, right? So that's why there obviously is a cost increase from today. Like if you start today, so the running costs might also shock a lot of people if they like analyze it for only one product, right? That's why it's also like a scalable case, investment case for companies, especially banks stepping into that business. But nevertheless, with increasing volume and also increasing parts of the value chain being covered by DLT and by smart contracts, we can, in our expectation until 2028, realize up to reduce the cost up to 71% for the domestic case. And this is also, of course, like will decrease not at once at 2028. It will linearly decrease with like added features that are missing as of now.
And maybe one addition, we did not look at parallel run costs, so we did not look at, we did not incorporate costs for the period of time where you actually have to run parallel IT systems. And it's also not a business case view, which means we did not incorporate change costs. Project implementation costs, those are not implemented here. So it's basically a standalone on-chain run perspective versus today's off-chain world.
Correct. And the reason behind that is we did projects for banks together, especially focusing on IT architecture, codifying, estimating how high the costs are to run the systems in parallel, how high the setup costs are. But one finding is from our projects that is varies very strongly from bank to bank. So it doesn't make sense to come up with average numbers here because it wouldn't tell anything about a specific bank.
And I think also and what we like overall the market maturity is also just not there, right? So you still have not the competition also, for instance, among custody tech providers. I mean, it is there, but it's still at a very the market is very young still, right? So it still has to develop. Also, competition is still increasing, and that's why also pricing and like the market is still settling also on the pricing point of view so far. And this is will change, of course, over the next years. If you look at the cross-border case, though, we can realize already cost savings as of today. Why is that? Because as we saw already in the visual before, the cost for clearing and settlements and securities accounts are quite high.
It's a cost basis effect, basically. So the on-chain costs basically remain the same, but you have a higher cost base.
Exactly. And therefore, we can realize in this scenarios already cost savings as of today. And also interesting, I mean, today, like banks and financial institutions, they always differ between cross-border and domestic. At the end of the day, for the technology, it doesn't matter, right? So that's why also in the ideal scenario 2028, we don't have to differ here anymore because it's the same cost basis anyway. So that's, I think, also a bit of the beauty and allows a lot of innovation for financial institutions to access, and also opportunities to access, because you can, for instance, in the cross-border space, access new business opportunities and offer solutions for your clients. And I think this is quite interesting. I think maybe to sum up the data point of view, we only looked at bonds. Every financial instrument is different. Also the cost basis, like the implications that we realize you can like use them and also map them for other financial instruments. But we know also, for instance, structured products, funds, and other financial instruments, you have already cost savings as of today. This was only a look at bonds, so this is very asset class individual. So I think that's also maybe a good point to jump to the next slide. That I think depending on the instruments that your organization is processing, that the cost saving potential is quite individualistic and differs highly from the instrument and also from the market that they are being processed on.
All right. So what are the major implications from our study? I think the study does make a case for a more diversified DLT product portfolio. So if you look at revenue-driven products today, especially when you think of crypto trading, which is a revenue-driven product, we do find evidence in the study that the cost and efficiency-driven products are also monetizable. And I think, therefore, from a customer's perspective, at least if you do it right, nothing is going to change. So if you have like an on-chain bond or an on-chain stock, and you tokenize it and move it on-chain, if you do it right, the customer doesn't feel the difference. But from the supplier's perspective, from the production perspective, you can actually have vast innovations along the entire production process, reaping those efficiency potentials that we talked about earlier. And the other thing I believe is that for the cost cases, it's even more important to have sufficient volume and scale. And that's why if you conduct use cases and POCs like that, it's important to think about the scalability of your use case in the IT and operations part right from the beginning. And that includes the definition of clear DLT capabilities and the IT building blocks that are needed to deliver on those DLT capabilities, and also make important sourcing decisions along the production process. And also, I think a very important strategic decision to make is whether or not you want to incorporate as much efficiency potential as possible for yourself, or whether or not you try to share some of that, for example, downstream in your own sales organization, and potentially even use it as an incentivization tool for selling your products. So, but that's, I think, it's a rather strategic decision to make.
You want to add something? Otherwise, I think great presentation, great study. Of course, a few questions to arise. Why did Dirk have to leave further to do this study? That's one question. The second one is, of course, to have, let's say, this normalized analysis is great, but we all know that the main benefits from DLTs will only come true if we package multiple dimensions into it. So my next question would be, and maybe you give a very short answer because we have to rush to the other room. By adding kind of which layer you see the way forward, ESG data, reporting comes in, the digital euro comes in, we can connect, tokens with operational issues, at least if we talk about the industrial layer. So what's your guess? In which direction will the universe expand after this base case? Anything? Or if you would have to do this study in 5 years' time, which dimension will be, let's say,
So actually what we just looked at one single asset here, and to to realize the efficiency potential that we calculated, still stuff needs that. So first of all, it needs a scale, and we need to have a Cashlink. Why the Cashlink? Because we need to what we always say, and a key result of the study is that tokenization of assets is not the finish line, it's the starting line. And to really raise and to the efficiency benefits, you have to select processes, and this is actually where now the incumbents or the TradFi institutes are starting to put a lot of brain into. So they raise the question for themselves: with which processes should we start to put it into a smart contract? Because for some processes it makes a lot of sense. For other processes, it doesn't make sense at all. So this is actually the current status where we are. That if you ask me what will be the next step, what would be great, and I think that this is where the market, at least definitely long-term, will develop, and not short-term and not mid-term, is that you will have financial products that are investing into digital assets. And then you have a completely other degree of automation. If you have a certificate or an ETF that was a smart contract, then it can invest into other digital assets. And this is an efficient potential that we even have not quantified here. So I think if you ask me, then the next step will simply that will be broader across the whole value chain.
And also, I think if I add one thing, to incorporate this into a real business case, I think it's also something that would be very valuable for market participants. So if you add change costs, implementation costs, parallel run costs of your IT, for example, I think that's where you basically can start making a real investment case, business case. And I think looking at this individually, I think that's a very important tool for those people in the major banks, major asset managers. They want to drive these assets, these use cases forward. Because it really helps, and we know this from experience from our current project. That if you can make a monetization statement, an amortization statement, that really can open doors for additional funds to actually conduct more use cases and more use cases in a shorter amount of time.
Okay, thanks a lot. I heard a very inspiring talk at World Economic Forum this year from will.i.am. He said, well, my ambition is to create the AI algorithm that will provide basically the best song, and that my family can benefit from it through smart contracting or down generations, because AIs will not die, so they can compose forever. So we need to think, I think, about these endless use cases that come along. So that will be quite interesting. So I'm sure we'll hear more, not only from you guys, but also about that topic at the next edition of Crypto Assets Conference in October. And now, without further ado, let's move to the main stage for goodbye. And hope you had a good day, and see you soon.